Good evening, doctors, and welcome to today's webinar. My name is Banga. I'm one of the senior consultants here at Cirrus Consulting Group. We have an interesting lecture this evening. We're co-sponsored by Hiers, who will also be speaking with us. He's a director in business development individual at Quadrant Advisory. And today's webinar is on minimizing the lease costs in your dental office lease agreement and converting cash flow into big retirement savings. So Casey's here also to support doctors, and we both support the dental community. In particular, we work with doctors across the country when it comes to negotiating the terms of their office lease agreement. Casey, on the other hand, with Four Quadrants, works with dentists across the country and really making their practice profitable, and in turn, turning them into multimillionaires. Really, it's about cash flow and savings and putting the practice and running it efficiently. So we'll begin with the leasing side of the table, which is a very important document that many doctors sign at the beginning of their career and certainly has bearing on their ability to sell the business. So just to give you a bit of background on the firm, we are a group that was essentially started back in 1994, a little over 23, going on 24 years now. We essentially are designed to support the dental community when it comes to understanding the intricacies of the lease agreement and this very complex document that they're expected to sign at the beginning of their career. We provide guidance when it comes to not only negotiating the rent rates and additional costs, but also providing education to doctors on the various legal provisions that are built into the lease agreement, how it impacts their business, their tenancy, and their ability to ultimately sell the business. Over the course of our 24 years of existence, we've negotiated over 10,000 lease agreements across the country. This not only includes Canada, but also all across the United States. And on an annual basis, we'll get involved and represent roughly 1,000 doctors when it comes to negotiating their lease agreement. The way that our group is comprised is a bit unique. We're not your traditional brokerage firm in the sense that we, go out there and look for space or, really work on commissions based on the aggregate rental rates from the deal. But we're essentially operating on the behalf of our doctors and representing their long-term interests when it comes to negotiating their lease. The way that our group is comprised is we have an in-house legal department, all in-house attorneys with a background in healthcare and tenant representation. We also have an in-house leasing department who work on the ground and essentially provide us a snapshot of any area across the country to get a better understanding of the going rental rates, availabilities, comparable properties. So we're essentially equipped to provide data for any real estate market, whether that be in Canada or the United States, to really ensure that we're getting a favorable deal when it comes to the financials of the lease negotiations. And the third department is the department I'm a part of. It's our consulting division. It's all of our consultants on our team have a background in business or finance, and really we're equipped to educate doctors across the country when it comes to understanding the importance of the lease agreement and really providing them with some education as it pertains to that very complex document that you're expected to sign. In addition to providing guidance for doctors, we also provide many educational seminars across the country. Very often I can be found on a plane traveling state to state, city to city, providing lectures for doctors when it comes to dental-specific real estate matters. So in any given year, we'll run about 150 seminars that are CE credited, whether that be at a major dental conference, such as the Yankee Dental, the Pacific Dental, Greater New York Dental Show, or the CDA. But really, the focus there is to provide guidance and better understanding on the business side of the practice, as most doctors are very educated on the clinical side and really how to do the clinical work and work with doctors, work with their patients when it comes from the oral care. But on the other hand, not as much background when it comes to making critical business decisions such as negotiating the lease agreement. So part of what we do is provide these extensive lectures on how to negotiate a better deal, providing provisional changes and understanding of very often found language in the lease agreement to ensure that doctors are aware of the various obligations and commitments they're signing on to when it comes to the commercial real estate agreement. And of course, we work with dentists all across the country, whether that be in the United States or in Canada, again, providing guidance in the realm of real estate. So what is the purpose of tonight's webinar? The purpose is it's twofold. Not only are we going to be working on understanding how to make the practice more profitable, but also to understand the importance of the office lease agreement, why it's a fundamentally important document, why it's important to negotiate a better deal or a more favorable deal from a legal and financial perspective. We'll also spend some time today during my brief time with you to go over some key terms, conditions, and provisions that are often found in a standard office lease agreement. And very commonly, we'll see very standard language across the board, whether you're in New York or California or in Texas. Very often, we'll find standardized legal language built into a lease agreement that is often quite favorable for the landlord. I'll also provide some guidance on how to practically negotiate an office lease agreement. Before I dive into further into the webinar, I just wanted all of you to be aware that as a dentist, you are one of the most sought after types of tenants for a landlord to have in their property. And what I mean by that is, when you look at the default rates for dentistry when it comes to commercial lease agreements, the default rate is less than 3%. On the other side of the table, when we're dealing with restaurants or nail salons or any other commercial tenant, very often that default rate is quite substantial. So what makes us unique in the commercial real estate realm is not only do we invest quite significantly into the build out of the practice, but we also are the type of tenant that once we've built our practice home, we typically don't move. And from that perspective, it's important to understand that you are a very valuable tenant to have in the property. And with that being said, there is leverage to be had as a dentist when it comes to negotiating fair rental rates as well as legal language within the lease agreement. So the first question I'd like to pose to all of you is very simple. What is a lease agreement? And I'll give you guys a few seconds just to think about that, and what is the first thing that pops into your mind? Speaking with many doctors, when I ask this question across the country, the first thing that pops up in their mind is, it's an agreement. It's an agreement illustrating the obligations between landlord and tenant and what that commitment will entail. But on its surface, a lease agreement is quite frankly a check. It is one of the biggest checks that you will ever commit to in your entire career. And I'd like to repeat that. It is actually one of the biggest and most important checks that you commit to in your entire career. Very often, many doctors will stay in their location for 10, 15, and in most cases, 30 years, they'll be in their practice home. And I'll give you a very practical example. The average rental rate for a 2,000 square foot, and this is just based on our experience with working with different markets, and of course, in every market, rental rates are very different than others. But on the whole, as an industry standard, we see rental rates for a 2,000 square foot space being roughly $5,000. And if we multiply that number, $5,000 for a base rent, and we multiply it by the 12 months in 1 year, we're equating to a $60,000 commitment in one given year. And that is just on base rental rates alone and not additional. In most cases, as we move forward through our lease, there's typically escalations involved, where rent goes up year over year, whether that be based on CPI or a factor of inflation, or a pre-designated number, very often 3%. But for argument's sake, let's keep the rental rates flat over that course of the 10 years. And if we take the $60,000 that we're committing to in that one given year, over a 10-year period, that is a $600,000 commitment. Now, the average practitioner for a dentist stays in their location for a period of 30 years. So if we keep that number stagnant as well and keep it without any escalations, we're looking at a $1.8 million commitment over the period of 30 years. Again, I'd like to repeat that, a $1.8 million commitment. Now, when I speak with doctors, very often they just look at, what they're paying over a year-to-year basis. One thing that I would like to implant in all of your minds today is not to think of the lease agreement as a year-to-year commitment, but really look at it in its total. Let's look at it in its full version and look at the lease agreement through a telescope. What is our commitment? How long we're going to be in the space? And in many cases, we're looking at that 30-year commitment. And with that being said, had your advisor or your attorney or one of your colleagues, had they ever told you that you were committing to a $1.8 million agreement, would you have spent more time taking a look at the various terms, provisions, and going through the lease agreement line by line? In many cases, most doctors just look at page 1 of the lease agreement, which are the base rental rates, how much square footage they're taking, as well as how long they're committing to the space. I'd like to get past that and really focus on the various nuances within the lease agreement because it does have an impact on your current tenancy as well as your ability to sell. So why is this document so important? Why is this 60, 70, sometimes 100-page document so fundamentally important? For one, it provides us with long-term stability and security in the space. It provides us with adequate term. When we commit to a 10-year lease, it allows us to facilitate our entire career within that space, but it also allows us to remain as a tenant without question from the landlord once we have a solid and well-designed lease agreement. It also allows us to minimize our risk and exposures. So what I mean by that is, typically when I speak with doctors, most often, this is roughly 80% of doctors, sign their lease agreement with a personal guarantee. Part of what I'd like to educate all of you on today is the negative impact of signing the lease agreement personally. One of the first recommendations I'd like to make is to sign the lease agreement through your corporate entity. Very important from a risk and liability exposure standpoint that we negotiate the lease agreement by having some form of a veil of protection vis-a-vis a corporate entity. So whether that be a PC, an S-Corp, an LLC, I strongly encourage you to speak with your CPA at some point in regards to incorporating your business for the purpose of signing the lease agreement through your corporate entity. Very important from a risk and liability standpoint. It also allows us to maximize our flexibility. And with that being said, there's a particular provision I'd like to discuss, and I'll go into a bit more detail when I get to that particular part of the webinar, but it's in reference to the assignment language. And very often, when we are looking to sell the business, the language that's illustrated in the assignment or transfer provision dictates how that process will unfold when we get to the end of our career and decide that we ultimately want to sell the business. In most cases, we require consent from the landlord, which is quite arbitrary. I'll go through a great example of how a well-designed assignment language is structured, which benefits you as a practitioner and allows you to have the flexibility to ultimately sell the business. In addition, there's a provision that I highly encourage all doctors, if they do not have in their lease agreement today, it's a provision called the death and disability provision. It sounds morbid in nature, but it certainly is of benefit for all of you as practitioner, given the nature of the business you're in. We're in a hands-on business where our hands are our main tool. And God forbid something happen to us, whether that be a death, a disability, an incapacitation, whether that be mental or physical, there needs to be flexibility in the lease agreement for us to have some form of termination rights. And I'll divulge a bit deeper into that as we move forward in the lease agreement or in the webinar, but it's certainly a benefit for us to include into any negotiation, particularly given the type of business we're in. And the document is very important because it also structures out fair and affordable financial terms, not only today, but tomorrow, the day thereafter, as well as 10, 15, 20, and 30 years down the road. The rental rates we structure today will have an impact on our overhead costs as we move forward in our career and further into our lease agreement. Very often, lease agreements with the rental rates, they typically go up year over year. Very rarely do we see rent rates go down. So it's very important at the onset to negotiate fair and affordable financial terms, not only on the base rental rates, but also on the additional costs. In most cases, and I would say about 90% of the lease agreements that I review on a weekly basis are some form of a triple net lease. What a triple net lease is we are committed as a tenant to not only pay our base rental rates, but also pay for any additional costs such as taxes, maintenance, and insurance. And very often we see landlords levy the ambiguity in the maintenance provision and levy additional costs to our tenants as a common area maintenance cost. I'll teach you a strategy on how to prevent that from being an issue and really hold the landlord credible when it comes to passing on any additional costs. So one thing to take note of, and very critical from when we sign the lease agreement or through any renewals or extensions of any options, it's important that we're aware of the very critical aspects and components that comprise of the sellable nature of our business. And the three main components that come and factor into the valuation of your business are the depreciated value of our equipment. So we take the present day value when we initially purchase our equipment and go through a depreciation formula which an appraiser or a formal equipment appraiser would go through to determine what the current value is of that equipment. That has a bearing on our valuation of the business because that is one of the first factors that get valued when we go through the appraisal process. The second portion of the appraised value of a business for a dental practice is the goodwill. And what goodwill is, it simply boils down to cash flow. What does each patient derive for us on an annual basis, and how often are they spending that value in the business? And the third and underlying factor from the valuation of the business is the lease agreement. Is it transferable? Are there fair legal language that mitigates any risk and liabilities, as well as are there transferability or transfer rights built into the lease without any penalty? When we factor in these three major components, we determine the overall value of the practice. For those of you that are on the tail end of your career and are looking to transition within the next 5 to 10 years, I highly recommend that an investment is made on the equipment side. Many doctors I speak with that are in the later stages of their career and are getting the practice valued often have a young associate enjoy that the space is well designed, it's well built, but the equipment is dated. If we're looking to get maximum value from the sale of the business, I certainly recommend investing into new equipment and technology to up the value of the business. Any associate today is looking for a paperless practice that has full digital equipment as well as a panel machine. Certainly beneficial from the value of the business and something that we should take into consideration 5 years before we start to sell the business. So what is in your lease agreement? And I'm going to go through a few terms and provisions in the lease agreement that are often found within a standard commercial lease agreement for dentists. One thing that we do unique at Cirrus is we really design and carefully craft the lease agreement to make it dental specific, to include all the nuances that are present as a dental practitioner, to factor in that significant investment that you put into the business when you build out the practice, to factor in the idea that at some point in our career, we will ultimately sell the business and go through a transfer process. One of the first provisions I'd like to discuss today is the option to renew provision. This is found in 90% of office lease agreements. I'll give you a quick moment to review this before I jump into some of the mistakes and pitfalls found in this language. So the first issue identified is in the first sentence itself. It says, provided that Dr. Joe Black shall remain as the tenant, it shall have the option to renew this lease for a further term of 5 years, exercisable by written notice. The first concern with this option to renew provision is that Dr. Joe Black has its only and sole exclusive right to express any of those options. In no shape or form are those options transferable. They are specific to Dr. Joe Black. Now, what happens is when we get the practice appraised, in most cases, most younger associates who are often debt-laden coming out of dental school will require some form of financial assistance from a bank. They require a loan to acquire a business. So we get the equipment appraised, we get the goodwill appraised, we get the lease appraised, and we determine a value. For argument's sake, let's say $1 million. Now the younger associate will go to the bank and require a loan for $1 million, which in turn the banks will require a copy of the lease agreement to verify that it is a fair and reasonable lease, but more importantly that there's adequate term. And when I refer to the word term, I'm referencing time in years on the lease agreement. And part of their financing is contingent on there being 7 to 10 years of term on the lease agreement to amortize or spread over that $1 million loan. However, if we are in a 10-year lease with 2 5-year options and we are in year 8 of that lease agreement and we look to assign or transfer that lease to that prospective buyer, those 2 5-year options, if they are structured like this one that we're reading here, those 2 5-year options cannot be exercised by the associate. They can only be exercised by Dr. Joe Black. So absolutely critical that we ensure in the lease agreement that any options that are available are not only available to us as a current tenant, but also available to any prospective buyer or transferee or assignee of the lease agreement. The second issue with this provision is, and if the tenant duly and has regularly paid its rent and has performed its covenants and obligations under this lease and has not been in default. Now, it's important that we take into consideration what's in the default. What does it say in the lease agreement to be in default of the lease? In many cases, there'll be a 2, 3, sometimes a 5-page document referencing what exactly default consists of. And if rent hasn't been paid, which sometimes rent is missed, for banking errors, for name changes, things of that nature that are sometimes out of our control, that should not be deemed a default of the lease agreement, and we should still be able to express our options. Very important that we understand what exactly is the default and that there is cure periods to remedy those defaults or cases that the landlord has notified us that we could be in potential default. It also goes as far as understanding some of the conditions in the default provision. In some cases, landlords will have shopping hours. For example, when we're dealing with a mixed-use plaza, there's typically shopping hours illustrated where the practice needs to be open from 9 to 5, Monday to Friday, Saturday 1 to 2, Sunday 10 a.m. to 2 p.m. In situations like that, we certainly want to ensure that our practice is operational during the business hours of the plaza, because we could be deemed in default simply based on not being operational on that one Friday a month. The other issue with this provision is any such renewal shall be on the landlord's then current standard form lease. So we may have negotiated a great deal from the onset when we initially signed the lease, but any options based on this provision and how it's structured would stipulate that we need to transfer our rights to a new standard current form lease, which could mean potentially that any of those issues that we previously negotiated out of the lease agreement or negotiated into the lease agreement will be null and void as they're moving to a new standard form lease. We typically want to have any options based on this current standard form lease that is in place at the moment. The other issue with this is that in no event shall rent be less than the rent paid in the last year of the original term. For example, this was quite problematic back in 2008 when the real estate mortgage crisis occurred. Um, I'm speaking with many doctors in Florida who signed their lease agreement in 2007 at the height of the real estate market. Rental rates were at their highest point, and falling 2008 crashed quite significantly. For doctors that are paying a higher rental rate, according to this provision, they can only negotiate on rental rates that are above their current rent rates. Quite problematic because if the economy has changed and we've seen a decrease in the economy, it should be reflected and rental rates should be based upon fair market value. And when I'm saying fair market value, typically what we do is we get comparables from various markets from a 5-mile radius snapshot of what's going on in that local community, what availabilities are there, and what competitor landlords are charging for their space. And based on those numbers, we will get an aggregate or consolidated rent rate report that determines fair market value. And rent rates should be based on fair market value as opposed to increasing year over year. The last issue with this provision is the rent shall be determined by arbitration based on the market rent for renewing tenants in the building. Now, on surface value, this may seem fair, given that if one tenant in the property recently negotiated rent rates, then our rent rate should be based on that. However, it doesn't factor in if, for example, a doctor or another tenant in the property required an improvement to their space but weren't able to fund it directly from their pocket and instead took an inducement allowance from the landlord, which means that any payments for a build-out or improvements of their space would get rolled into their rent rates, which typically means their rent rates would be above market rent. Completely unreasonable for a landlord to have us renewing on the last renewing tenant in the property. Certainly it can have an impact on our overhead and cash flow going forward for the next 10, 20 years, given where that new tenant renewed their lease based on. I certainly recommend all of you take a look at your option to renew provision. It certainly has language in it that could have an impact on your ability to express those options or any proposed assignee express those options. The assignment language, which is found in 75% of dental leases, and this is comparable language that is often found. And arguably, this is one of the most important provisions that are found in a lease agreement. It dictates our ability to transfer the lease agreement from party A to party B. So for the first issue with this is that we need to get consent from the landlord. So once we determine a buyer for the practice, we need to go to the landlord and say, hey, Mr. Landlord, we're looking to sell our business, and based on the lease agreement, we require your consent. Typically how that conversation goes is the landlord says, you know what, I'm more than willing to grant you consent, but I'm curious to know, what are you selling your business for? And in cases like that, most tenants would respond, well, you know what, all we need is your consent. I'm not comfortable with sharing that number with you. And from the landlord perspective, what they say in turn is, it's absolutely our business, because if I don't provide consent, you can't transfer your lease. And again, they'll ask you, what are you selling your business for? And if we're selling our business for $1 million, many landlords will levy their ability to provide consent or withhold consent to derive some value from that transfer, a portion of the sale. It's becoming more and more of a concern when we're dealing with commercial real estate, because we're seeing clever landlords understand that a large transaction occurs when a dentist sells their business, and very often they believe that that value is attributed to you being in their property. And as a result, believe that they're entitled to some form of consideration or value when you ultimately sell your business. The other issue with this option, and again, this is found in most lease agreements that I deal with, and in the course of any given week, I'm speaking with 10 to 20 doctors when it comes to understanding their lease agreement. And with respect to this particular portion of the assignment language, the landlord shall have the option to either terminate this lease. So immediately, simply us requesting consent, the landlord can terminate the lease, or to revise the minimum rent to be paid during the remainder of the lease to the greater of the then current market rental rate of the lease premises by 15 greater % than the current market rent. Certainly not ideal, particularly when the practice is getting appraised. Because the lease agreement factors into that appraisal, having a 15% increase on rent simply when we're transferring the lease agreement will have a impact on our bottom line and will factor in to our ability to sell to an ideal candidate. The last issue, and this is language that I would say is found in 90% of lease agreement, it says tenant shall not be released from its obligations under the lease and shall remain liable for any failure of the tenant or its assignees or subtenants to observe each and every covenant of this lease. So even after we sell the business, it states in this assignment language that we would remain jointly and severally liable with the buyer of our business, even though we've cut ties with the practice. Not ideal to not an ideal position to be in. Typically, the ideal scenario would be upon transfer and sale of the business, our liability immediately ends. In some cases, given that a younger associate would be buying your practice, some landlords require some form of joint liability. In that case, we would want to limit that liability to a set period of time or cap it at a set value, but not have this unlimited joint liability. Just in the interest of time, there are a number of other issues that are found in office lease agreements stemming from assignment language, demolition, relocation, death and disability, surrender rights. The two provisions I discussed is just the tip of the iceberg when it comes to the lease agreement. As you can imagine, going through a 60, 70, or 80-page document that is full of legal jargon, much of that lease agreement is in favor of the landlord. And part of what we do is we advise and review documents on behalf of our doctors or prospective clients so that they understand the various provisions and critical items in their lease agreement, as well as providing them recommendations on how to put them in the ideal position when it comes to liability and risk. One thing to take note of before I pass on to Casey at 4 Quadrants is, doctors, please take note of the critical nature of the tenant lease cycle. Ideally, we begin the process 2 years in advance. 2 years before your lease is set to expire is the ideal point when we have leverage in the negotiation. As we get closer and closer to our termination or expiration date, our leverage stance significantly reduces. Landlords are aware of the nature of our business, that we can't pick it up and move. They understand as soon as we get in that 1-year window, very difficult to move the practice, identify a new location, go through site drawings, permitting, very difficult to go through that build out and become operational when your lease expires on this current location. And as a result, most landlords would delay it and delay the process because it puts them at a better leverage position to present you a take it or leave it deal. If you don't take the deal, well, they have a built out dental space that they can re-let at a premium to another dentist. Or alternatively, you're paying a higher rental rate. Certainly of benefit to begin the process absolutely early. For any doctors that are on today's webinar, part of our sponsors have provided our doctors is the ability to go through a complimentary lease review. So I can certainly review that lease document on your behalf, understand your critical dates, as well as some of the potential risks and traps and various legal nuances built into your lease agreement. So what is part of our process includes, and this is our Cirrus process that's been, really refined over the last 23 years in the experience we have. Number one, we would gather all documentation, whether that be the current lease, any extensions, amendments, addendums. Then we would set a call with you to identify your practice and career goals. How long you plan on practicing? Is this one practice that we want to own, or do we plan on having multiple offices? Are we running a multidisciplinary practice? And really, what does our long-term transition plan look like? Then we would go through a 2 to 3 hour review of the office lease agreement, go identify all the risks, highlight the critical dates, understand the various obligations that you have as a tenant and that you're committing for the next 10 or 15 years. Then we would review the actual local market data. I would send a report to my leasing department where we would get a consolidated rent rate analysis of comparables, availabilities, and going market rental rates. At that point, we would sit down with you as a doctor and come up with an outcome and strategy development plan. What do we look to achieve? What amendments are high priority? What items can we concede on? And what end goal are we looking to and result are we looking to achieve? At this point, we have yet to pick up the phone and call the landlord. All we've done since then is get prepared for the negotiation. And that is the key. Again, I like to reiterate, 2 years is the ideal window to begin the negotiation process, and certainly of benefit to begin that process earlier so that we can go through step 1 through 5 before we even pick up the phone. Step 6 would be to negotiate the economics of the deal. What rent rates are proposed, what the escalations look like, any inducement allowance from the landlord, any rent-free periods for a startup practice that's going through a build-out, when the rent commencement dates are. These are all the finances with the deal, all the numbers, all the financial commitments. Very important that we negotiate that first and foremost. Once we've hammered down the economics of the deal, we would move to the actual lease agreement, going through the various terms, provisions, going through multiple iterations of the lease back and forth with the landlord, and coming to a position where we're comfortable with signing the lease agreement so that there is no rights such as a relocation, redevelopment rights, which can put our tenancy at risk. At that point, we would go through a final execution and review of the lease agreement. So we want to ensure that the final document that we're about to sign and commit to for the next 10 and 20 years is consistent with the terms that we negotiated. So all that we spent the last little while negotiating back and forth with the landlord is all involved and built into that final lease agreement. So that is essentially our process, and whether you do this through our group or you're looking to negotiate a deal yourself or with a colleague or a broker or an attorney, I certainly recommend following a process like this where we're well educated on exactly what's involved with the negotiations, all the key documents that are involved, understanding the local market and landscape in terms of rental rates and comps before we pick up the phone and speak with the landlord. So again, part of today's lecture, we offer a service which is a critical dates and risk analysis. It typically costs about $15, but given our sponsors for today's webinar, we will certainly be able to provide that service on a complimentary basis. And essentially, we'll spend 3 to 4 hours assessing the lease agreement, identifying any risk traps, providing you with a treatment plan for the practice and the lease agreement, but really understanding your vision, your plan, what your career trajectory looks like, uncovering any traps that can have an impact on your tenancy and be of a certain great liability to you, and then presenting you with what the ideal lease should look like. From there, we'll provide you with strategies on how to negotiate the lease effectively, as well as providing you with tactical plan on how to achieve those various changes that we recommend. So again, my name is Banga. My contact information can be found here. I'll have myself or my colleagues reach out to you all following today's seminar to see if you do want to take advantage of the complimentary lease service. Part of our sponsorship deal is that service will only be offered for 2 weeks following today's webinar. So if you are interested in setting up the complimentary review where we go through the legal provisions within the lease agreement, as well as provide you with a consolidated rent rate report to understand where you are in line with the market when it comes to rent, I can do that for you as part of a complimentary service that's offered by our partners and sponsors. But again, please do reach out to me within the next 2 weeks to set up a call and send over the documents, i.e. the original lease documents, any extensions, amendments, or assignment documents. I'll have my legal department review that on your behalf, structure a 1-hour call where we can go through that and I can present you a negotiation strategy. I'd like to thank all of you for joining me today for the leasing portion of today's presentation. I'd like to pass the mic on to Casey at Quadrants, where we can discuss how to make your practice really profitable.
Thank you, Jazz. I appreciate that. Ladies and gentlemen, my name is Casey Hiers, and I am a director at Quadrants Advisory. Tonight, I'm going to be touching on key strategies for building a profitable practice and retiring on your terms. Most of you got into dentistry primarily for reasons other than wanting to own and run a business. We've been helping dentists and specialists for a decade and a half, and one of the reasons that we rarely hear is that the main reason I got into dentistry is to run the day-to-day operations of the business. Most of you got into dentistry because you were following in a family member's footsteps, perhaps, or you enjoy helping people, the creativity of working with your hands, flexible schedule, things of that nature. But interestingly enough, most dentists say that their biggest challenges and stresses are from the business side of the practice. So things that are worrisome aren't so much the clinical, but you're talking overhead, practice account balance fluctuation, income, wondering where all the money is. Feels like you're busy, feels like you are doing all the right things and doing great dentistry, but where's the money going? How about tax surprises? Although a lot of the dentists that I've been speaking with, they're not surprises anymore because they're so used to them. General cash flow, retirement plan, practice transition planning, insurance adjustments, all of these things are what we hear are the biggest challenges and stressors for dentists. And not shockingly enough, there's a good reason for it. You know, most of you, again, went into dentistry for clinical reasons or reasons other than the business side of the practice, number one. Number two, you received little to no business training in dental school. And number three, what we see is that most of you bear the workload of 5 C-level executives on top of performing dentistry. So depending on how your practice is structured, everything falls under you: Chief Executive Officer, Chief Operating Officer, Chief Financial Officer, Chief Marketing Officer, Chief Technology Officer. So as a result of all of this, we end up with statistics like this, and these are the most recent statistics that the ADA has shared with us. So these come from your peers. And the first stat that I want to touch on is $26,000. The average dentist is saving $26,000 for retirement. And you may ask yourself, is that enough? And 96% of you say that you are undersaving for retirement to maintain any sense of a current lifestyle. So can we just all agree that dentists, generally speaking, don't save enough for retirement? But we, in our conversations with dentists, there's always that last payday, right? Selling the practice. And the thing that the most sobering statistic on this is that 80% of associates do not become partners. So to be proactive in succession planning, you need minimum 5 years, and it's just a false belief that selling your practice will make up your retirement or the majority of it. Now, some of the things I'm saying are a little bit startling. I want you to know this is normal. A lot of dentists feel like they're on an island. And so you're not alone if that's how you feel. Like I said, we partner with dentists and specialists all over the country who are faced with a lot of the same challenges. And in our work with dentists, we've identified 3 initial financial pitfalls that, if go unaddressed, can crush your practice. And I'm going to touch on them today and ultimately hope to give you a couple pearls of wisdom that you can return to your practice, make some adjustments, and, number 1, continue to build a practice that you enjoy, and number 2, make some changes that can allow you to retire on your terms. As I discuss these strategies, you're going to notice that it all has to do with cash flow. And if you find yourself enduring tax surprises over $10,000 most years, either refund or owe $10,000, it's considered a tax surprise, along with insurance adjustments that are 20, 30%, you're done. Your practice and your retirement will suffer. And unless you begin to add methods and strategies like I'll talk about today, it's going to be difficult to improve, and you can't produce your way out of it. And I'll give you an example of that as we progress this evening. So key strategy number 1 is to right-size your income. And again, these are initial strategies where we're building the foundation. It's a domino effect, and if these basic principles are followed and done correctly, it's going to set you up for success on a much grander scale. But the first one I'll touch on today is to right-size your income structure. And what we mean by right-size your income structure, it's what and how you pay yourself. So ask yourself, what are you paying yourself? And more importantly, who set up your income structure? Is anyone out there familiar with the take it as I need it, or I'll just take what's left at the end of the month income structures? They're all too common but they should not be acceptable to any dentist. And the importance of right-sizing your income structure, it has major tax and retirement implications, and you can't just run and gun when it comes to that. So I want to encourage you guys to let's do a self-analysis, and I'm going to go through some indicators, and they may help tell you if your income is or is not structured correctly. So go through this with me. The first question you should ask, number one, do you know what your overhead is? General idea. And is your overhead increasing? Next question, how about your practice account balances? Are they in constant flux, or are they declining? And third, are your estimated quarterly tax payments won't even cover your year-end tax bill? These are just 3 indicators that if you answered yes to them, chances are your income, your income structure is just not right-sized or set up correctly. So how do you know if you right-sized your income structure? Lucky for you, I'm going to tell you. Our current strategy and the best way for doing that is a W-2 and distributions. Now, it's a W-2 and consistent distributions, and I'm going to go through a case study here that shows the wrong way to take distribution. But when you have a consistent and predictable W-2 and distributions, you're not going to have your year-end tax surprise. You're going to have adequate cash flow, and that's going to be the start of being able to take control of your finances. So I mentioned the case study, and this is an actual client of our firm. We'll call him Dr. F and his spouse. They were a multi-million-dollar practice in North Carolina, actually about a $3.5 million practice. And as I go through this, here's the example that you just can't produce your way out of it. But his income was structured and designed by a general CPA. This CPA, he had 10 or 15 dentists as clients, was not dental specific by our definition, but that's who structured it. And what we uncovered a couple things, but number one, he had 3 associates that were making more than the owner was in terms of percent of production. Now, a little background on Dr. F. He had a couple kids in college. He had 4 credit cards, a land loan, and 2 lines of credit. And I share that with you because his personal expenses exceeded his take-home pay by $100,000, 6 digits. And that's a big number, and so I like to give that background of what they had going on. But what happened was then, what do you do when you have a 6-digit shortfall? You cover them with distributions, except he was running and gunning, and it wasn't predictable or consistent. One month he would take $11,000, then $5,000, then $15,000. So no systems and processes in place, no methodology, and he was just running and gunning. And what then happens? Poorly designed income strategy equals unpredictability, tax surprises. Dr. F, well, he had a multi-million-dollar practice and was making $700,000 a year. He was enduring all of this and felt like he wasn't being the best that he could be. And so all of this was really challenging, the 6-digit shortfall, being very reactionary and defensive with the distributions, and then the tax surprises. So here's what we did. And there's a lot of detail, obviously, that I won't get into tonight for time's sake, but we adjusted his W-2 and we took it up to $270,000. And there's an IRS cap on retirement benefit, and so for 2017, $270,000 maximizes retirement. So we increased his W-2. His spouse was on the books at $74,000. We took her down to $25,000. Here are the 12-month results. Here's the snapshot. First thing, tax bill dropped by $16,500. The second thing that happened was we maximized the retirement savings by contributing an additional $25,000. No one on this phone call wouldn't want to take this trade. Drop taxes, increase retirement savings. And that's what we did. Number 3, we improved and stabilized cash flow. and we were able to have practice accounts. They grew, and this isn't overnight. It takes 9 or 12 months with the right team and the right strategies in place, but we grew the practice accounts to a level that was very impressive. But this is a snapshot of, again, an example of when you are playing defense and there's no systems in place, the domino effect that can happen. And so the biggest thing with the spouse, by dropping the income, there was a lot of taxes that didn't have to be addressed, Social Security taxes and what have you. However, able to maximize the 401k. Just a couple small examples of one or two of the dozens and dozens of things that can happen. So that's just a brief touching on the right sizing your income structure. Key strategy number 2 I want to touch on is establishing and adhering an ideal bank balance. So right where you're sitting on this call, on this webinar, I want you to close your eyes and visualize your practice accounts, your practice account balance over a 12-month period, over a calendar year from January to December. And just visualize the different amounts that you have in your account in any given 12-month period, and just kind of look at that. And open your eyes and think, what were you looking at? Was it a consistent line, or were you on a roller coaster? Many dentists are on a really bad roller coaster ride that they can't get off, and the roller coaster ride of practice account balances just going up and down, up and down, up and down is not one that you want to be on. And some are for obvious reasons, right? The challenges of low account balances are obvious, covering your financial responsibilities month to month. That's a big deal. What most dentists don't realize is that a bank balance that is consistently too high is a problem as well. The reason dentists tend to hoard large amounts of cash is for fear of the next tax surprise, because systems and strategies aren't in place. But when balances are too high, dentists are sitting on a ton of cash, but they're typically not saving it for retirement per se. It's not working for them. Time value of money. They're not enjoying any money at home. They're scared to make a decision or to buy something. And that's no way to live. You guys went to dental school and you work hard, or not paying debt down, or any combination of both. So when we talk about the ideal bank balance in the practice, it's very important. So the question is, how do you determine what your ideal bank balance should be? So here's a pearl that I'm going to share, and you guys remember this or write this down. The ideal bank balance is 10% of your annual production. So if you produce $1 million, you should have $100,000 in your practice account at all times. It's enough to cover a few bad months, but it's not so much that you're hoarding cash. And in any room that I'm in, there's always one or two people that they're sitting on much, much more than that because they're scared of the tax surprise. And there's always people that have much less than 10%, and they wonder how they could ever get there, and that's normal. So here is an example of when you, at least at our firm, when you hit your ideal bank balance for 3 months or more, we call 3 months a trend. This is showing the fruits of hitting that goal. And so in this example, this practice that we extracted the numbers from is about a $900,000 practice. So the ideal bank balance was $90,000. And so here's what's exciting. Once our clients hit these goals of their ideal bank balance, and we not only help them with the plan, we help them implement it. For us, we have fun conversations with our clients. So then you get to start talking about a pay raise at home. You get to start talking about some saving strategies, debt acceleration, or a combination of both. And so there is a light at the end of the tunnel when you can right-size your income, adhere to the proper bank balances. And once you hit these goals and get your house in order and these foundations, our clients start to have these fun conversations, as you can see here. And that's really where we think all dentists should be. So we touched on right-sizing your income structure. We talked about establishing it and adhering to an ideal bank balance. 10% of annual production is the ideal bank balance. Again, it's enough to cover a couple bad months, but not so much that you're just sitting on tons and tons of cash that's not doing anything for you. The third strategy I want to touch on is using dental-specific accounting to know your numbers and make informed decisions. And so this slide's very busy, I apologize, but what is dental accounting? Dental accounting is not an accountant who has 15 dentists as clients. We think that dental accounting should be so much more than that. First of all, when you talk about a dental-specific custom chart of accounts for your practice, we like to have 70 or 80 line items on our chart of accounts. Typically, we see 15 or 20, maybe 25. We think that monthly reconciliation of practice numbers that's integrated into financial planning is key. All-inclusive fees. It shouldn't be where, like some attorneys are paid hourly, because when you're charged hourly, you tend to not ask as many questions. We have a partnership mentality, and so you want an all-inclusive fee partner. Quarterly tax estimates, not just payments, but quarterly tax estimates blended with current forecasted practice performance to prevent those tax surprises. So that just gives you an idea of what we consider dental-specific accounting. Some other benchmarks, clouded QuickBooks, those out there that use them, they understand the beauty of it, but you're going to have a real-time dual access. The security and instant access is exciting. The monthly monitoring, it's just really important. I touched on the custom chart of accounts, and I just want to give you one example. Here's just a simple example. Instead of having wages as a line item, what's recommended is to break that out. Office manager, assistant, bonuses, payroll, hygiene. Is your hygiene producing 3 times what you pay them? Business office wages. This is just a real general example of a custom dental-specific chart of accounts to know exactly what's going on. If you don't, you could be embezzled from. You don't know your numbers. It's a simple concept, but it's amazing how many dentists that come to us, their chart of accounts is very basic. So obviously monthly updates, they allow for immediate evaluation and informed decision making, and that's a big deal, and that's important. Here's a real quick example just to illustrate the obvious, but poorly managed overhead can cost you. And in this example, one of our clients, in 2014, their income was $107,000. Their overhead was 84%. If overhead was just 65%, and to us that's a little high, the income would have been $396,000. So there's 2 points on this slide. Number one, it's obvious which one you want. You want more money. But think about when you go to sell your practice. Same practice, which one's going to be more attractive? Which one's going to fetch you a higher dollar? Ideally, overhead should be between 50 and 60%. Specialists closer to 50 or even under. General dentists, 60%. And those are things that our firm, we analyze, go over, advise on, and help implement 80% to get folks down to an overhead that is acceptable and can really help them in so many ways. So I touched on some benchmarks for the dental accounting, the custom chart of accounts, the clouded QuickBooks, all-inclusive fees with that strategic partner mindset, and that's really important. And for the sake of time, I'm going to go ahead and go on to our little circle of life here at 4 Quadrants. If you look at the 1 o'clock client tasks, our clients write checks, enter payroll, and daily deposits. That's it. So quote one of our clients, you take 95% of the stress off my shoulders from the business side of my practice. I can get back to what I enjoy, and that's the dentistry. And so everything else, you have a team at our firm that absolutely does that. So just real quickly, we touched on to build a profitable practice and retire on your terms, the initial foundation, the first dominoes that really need to be in place to have a chance at this is to right-size your income structure. It's different for, the W-2 is going to be different for every practice and every situation, but getting that consistency is very important, and consistent distributions, not haphazard ones. Establishing and adhering an ideal bank balance of 10%, that just adds so much consistency to a practice. It's very important. And then dental-specific accounting, to know your numbers. Accounting slides aren't the sexiest, I know that, but at Four Quadrants, our comprehensive team, we're forensic with our clients' numbers, and that's personally and for the practice. It's all blended together. And so Four Quadrants Advisory, we are a dental-specific, this is personal and practice, accounting, financial planning, business advising. We really do it all. We're like an external CFO. And I like to end the talk with where the rubber meets the road, right? What are some results? We did an internal case study of clients that are with us for 3 years. What are some of the averages that we have seen? And the first one is that overhead decreases by 11%. The second one is that income for our clients over the last 3 years has gone up 25%. Here's the big one. Retirement savings has gone up 870%. And when I do this presentation around the country, I hear gasps. And we have people that were saving $13,000, $15,000, $20,000 and said, I don't believe I could ever save $100,000. We have a new client coming in next week. We're taking them from 13. Year 2, they'll be saving $153,000 with us. He didn't think it was possible, but these are actual numbers from our firm. And here's what you're most likely asking. You're going to make me work eight days a week. The average annual increase in revenues to achieve these results was 1.7%. So we don't ask you to produce much more, and we don't ask you to change your lifestyle. I'll leave you with this. Here's what's possible. Our average client collects $1 million. They take home $400,000. They save $100,000 for retirement. They have no tax surprises. They have a comprehensive plan with a team to help implement it. Most are on track for 7- and 8-digit retirement. And our clients have someone to guide them every step of the way. Like I said, we implement 80% of what we advise. So for the folks that are on this webinar, we typically don't do this, but when we speak live, but I want to offer a complimentary evaluation to any attendees. Contact me, and I got my phone number and email, Casey Hiers, in the next 48 hours, and contact me in a way in which we can set up a more formal time to get to know you and your practice and answer some questions. I think that's important. But I'd love to speak with you all and see if there's something we can do to help you win the business side of dentistry, maximize the profits in your practice, and ultimately retire on your terms. At this time, I'm going to go ahead and turn this back over to Jazz.
Again, doctors, I thank you all for joining us today, and I hope all of you derive some value from today's lecture, whether it was on, understanding the nuances of your lease agreement, how to protect your interest via the lease and structuring it in an appropriate manner, or really understanding how to maximize the profitability of your practice and setting yourself up for transition planning. If anybody has any questions, you can certainly reach out to myself or Casey at Four Quadrants, and we can set up that consultation. I do recommend reaching out to us within the next, couple of days. On my end, our offer is available for the next 2 weeks. I know Casey and his team, they want you to touch base with him in the next couple of days. But if you do want to understand and get strategies on how to grow the business and really minimize your overhead costs via the rental rates or optimize the practice, I certainly recommend reaching out to either Casey or myself. Again, I'd like to thank all of you for attending. My email can be found at jbanga@cirrusconsultinggroup.com, Casey at chairs@fourquadrant.com. Again, look forward to speaking with any of you in the next little while. And if Casey has any comments you'd like to make before we close out, Casey, you're more than welcome to.
Thanks, Jazz. I appreciate it. I appreciate everybody's attention, and I look forward to speaking to some of you in the near future. Thanks, everybody.
Thanks, everybody.